With the aggressive half an interest rate cut that the Fed did, there's no question we are starting an interest rate cutting environment. So, in that environment, how do you maximize the interest that you're getting on your cash? I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. It's been a couple weeks now, but the debate between, well, is the Fed going to sort of wade into some interest rate cuts, or are they going to go aggressive? Well, they went aggressive. They made a statement. Oftentimes, the Fed's only going to cut interest rates by a quarter of a percent. If they're cutting interest rates or making an interest rate change, honestly, up or down, it's going to be about a quarter of a percent at a time, 0.25. Anytime they do more than that, it's typically in a crisis. Hey, we're behind, or we see economic storms coming, or something. And especially with cuts, that's when they go more than that. So it's a little surprising that they did cut interest rates by 0.5%, and then it was, of course, smothered with language. It's not because we think there's a problem, it's because we don't want to be late. You're already late. You're already late. So, but either way, to after all of the interest rate hikes, to have the first cut be 0.5%, there's no doubt about it. We are now in an interest rate cutting environment. Now, how long will it last? Like, will they cut every single meeting? I doubt that. But will they cut consistently, maybe every other or whatever, for the next couple of years? I think that's very possible. So how, in a interest rate reduction environment, how do you continue to make a good interest on the cash that you have at the bank? Well, I wish I could tell you that there was an easy way, or that there was a clear way, or there's this, a back door back here, and this is where all the good interest rates stay. But just like I told you on the way up, that just keeping money in a savings account and just hands off, set it and forget it, that's not the way that you're going to maximize your interest. Now, you've got to be active again. Now you can't just leave it as is. You've got to survey the landscape and make sure that you're making wise choices. Had an email from a client this week that said, all right, we just had a CD come due that had a good interest rate, and I can't find any good interest rates out there. I don't want to just put it in my savings account. We already have $20,000 in there and it's paying next to nothing. And should I put it in my money market account, or is there something better? How can I get a competitive interest rate? Well, again, there's no silver bullet. There's no perfect scenario to keep getting higher interest rates now that we're in a lower interest rate environment. But there's a few things that you can do and should do, and this is what I explained to this friend of mine. First is lock in good interest rates when you find them. Lock them in for as long as you possibly can. I happen to know in our area, there is one credit union, one bank that still had interest rates on their CDs above 5%. And those of you that don't watch these numbers, you might say, well, yeah, everything's above 5%. No, nothing's above 5%. It is like you blinked and it's gone. No CDs are above 5%. And obviously I'm exaggerating because at least in our local area, we found one. And you might be able to survey your area or online and find some as well. But where it seemed like every CD was above 5% just recently, now virtually none of them are. And so I told her, listen, this one institution still appears to have CDs above 5%. So therefore, the CD that just matured, if it's still appropriate to be, held in cash and CD, which in their financial plan that does make the most sense. I said, go there, confirm that these rates that they're posting online are still accurate, and do the longest maturity, the longest term you can get, which they had a 10-month and they had a 15-month. So I was saying, do the 15-month, lock in that interest rate for as long as you can. Now, if your baseline expectation is a CD better be above 5%, otherwise it's garbage. If you can't find a 5% CD in your area, but you can find a 4.8, 4.9, 4.75, and they're offering that for 2 years, or they're offering, lock it up. Lock it up for as long as you can, because guys, an interest rate reduction cycle is likely going to mean, just like you expect all CD rates should be above 5%, pretty soon rates are going to be in the low 4s or high 3s. So lock in competitive interest rates for as long as you can. Beyond that, and for dollars that need to be more liquid, because again, in this client's email, she actually said, as you know, we're going to be supplementing our retirement income with the excess cash that we have first. So dollars above and beyond, need to be liquid. So we can do this CD, but we also need to keep these other dollars liquid should they just sit in the savings account. And that answer is no. High yield or high interest money market account. High yield or high interest money market account. Now, this is sort of going back to the same playbook because a money market account offers, in my opinion, the three things that you need your bank account to offer. FDIC insurance, yep. Fully liquid, yep. And at no cost. It's free. So yes, it's FDIC insured. Yes, it's liquid. Yeah, there's no cost to hold it. After that, after those three conditions are met, give me the highest interest rate possible. Money market accounts, high yield money market accounts, typically have an interest rate that floats with the market. So your high yield money market might have been paying above 5%, and now you just received a notice saying they're paying 5% or 4.9 or 4.8 or 4.5. You're going to start seeing that interest rate go down, which is why the first idea was to lock in interest rates for as long as you can with appropriate dollars. But for the dollars that need to be liquid, okay, a high yield money market is the next best option, and just know that you're going to get a competitive interest rate. And as competitive interest rates go down, your interest rate will go down. But it's still better than just parking the dollars in a savings account earning next to nothing, or violating your financial plan and saying, yeah, these dollars need to be liquid, but I'm going to invest them in something that's illiquid, or I'm going to take some risk even though I need them to be risk-free. So that's the second idea, high yield money market. And then the third is, if you are still looking at your cash and saying, well, the dollars that it's appropriate to lock them up into a CD for a certain period of time, we've done that, or maybe lock them up into a treasury note, treasury bill for a long time. Yeah, we've done that, and then we've got a good chunk here in the high yield money market, but I've got some other dollars that I still just need to earn a better interest rate, and it's just depressing to see these interest rates go down. Well, then you might need to get a little bit more creative, and you might need to work with your CFP on some high dividend or some high yield investments. Now, you're moving off of the risk-free or the FDIC insurance, and you're moving into an area that, yeah, it's going to go up and down in value. But if your desire, if your financial plan, if your financial need is I need income, then you might be okay going off of those, it's taking a step up in the risk a little bit, and maybe considering an equity premium type of strategy as well. I've shared that before. Some investments have the ability to own stocks, but also have a juiced or higher yield on them because of some creative strategies that they're doing with options. And so getting off of taking a little bit of risk can allow you to get either a higher dividend or a high yield, giving some other more creative strategies out there. That's the third way that you can continue to earn a competitive yield even in a declining interest rate environment. Those are just three ideas, and again, there's no panacea. There's no perfect option. In a declining interest rate environment, it's going to be better for borrowers. It's going to be harder for savers. Harder for savers to earn a good interest rate. Certainly hard to keep up with inflation. So work with your certified financial planner. Do any of those three ideas work, or do you need to go to idea 4, 5, 6, or 7 based on your financial situation? So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go on and take your next wise step in your financial life.